Hi, I'm Mark Rossano, CEO and founder of C6 Capital Holdings, here with Serkan Sahin of Hummer's Straight Partnership. So today we're really going to focus on what has happened in the market. We've seen a lot of things in terms of oil prices going negative on the May contract. June, I think at this point, is down about 45%. And now the question is, does the contagion spread into Brent? And how does the market really react from a production standpoint and an export spot? So the first thing that I'll touch on, and then Serkan, I'm sure, is going to jump in with some great insights. Please. So the point at this stage is going to be what is happening in the WTI market. So when you see the May contracts going that negative, there's a mixture of things, both physical and financial. So it is a financial instrument. It's something where people are going to try to roll, especially if they can't find storage for what they thought they were going to have storage for. So as we go forward and we start to think about, okay, well, what happens in June now that the roll is complete, now that the May contract will fall off the board, what is going to happen in June? Like, are we going to see the same negative pricing that we've seen in May? I mean, Serkan, do you have any view on that?
Yeah, most probably, because what we see because of the coronavirus issue is there is totally unclarity about how and when these things will recover. So effectively what we see is there is no place in storage. Most probably Cushing storage has some other space that will be filled within few days. Like world and the US is full of oil. And the biggest question is there's a big unclarity, when everything will recover, when we'll go back to our normal life, when people will start again flying, driving, we will have a reasonable oil demand. And I think that's what we saw yesterday, the collapse of the system due to this craziness.
And you bring up a good point in terms of WTI when you look at Cushing and you look at storage, but yet we have all of this Saudi crude heading our way. Some estimates are up to 50 million, depending on how much actually hits our shores. But yet we have this glut at Cushing and some of the other areas. I mean, do you think some of this oil is going to get redirected to other regions, or are we really going to take the delivery?
I think so. Okay, most of this imported crude oil is going to PAD 3 storage areas and PAD 3 refineries. So it's very, very unlikely that Saudi crude oil will moving into Cushing. It will stay in PAD 3. It will stay in Gulf. But at one point, because of the price, some of the maybe storage operators and some of the refineries would not be reluctant to buy this crude oil. It's really possible, or this crude might just settle in offshore as a floating storage for a while. There might be issues that for the operators and for anyone that just this crude oil might stay really this is total unknown, I think, for everyone. And there are also some questions you can really help us, because some people are also wondering why this Saudi crude is still flowing into US if everywhere is full of crude oil.
It's an interesting point, and I think you can look at it, and you bring up something that I don't think is appreciated, and it's the floating storage capacity that can come in some of these shipping contracts. So when you look at PAD 3, and if you look at the U.S. as a whole, as you talk about coronavirus creating demand problems, we have a gasoline glut, we have a diesel glut, and we clearly have a jet fuel glut. So when we look at U.S. crude versus floating crude, you're going to have refiners making a choice, and the choice is always going to come from the higher quality. So this higher quality crude has the ability to sit in essentially right off the shores, right in that PAD 3 area, and these guys are going to be able to take advantage of, and by these guys I'm talking refiners specifically, Valero, PSX, and Marathon are going to be able to have that optionality. They can take from off the water, or they can take from the U.S. shale. And at this point, just based on the glut, you're really going to want to minimize that gasoline creation. And by doing that, it comes down to that crude quality. And some of this floating crude has that better quality, where it's a little bit heavier. It has, it's a bit sour, but they're positioned to run that and create some viable product, even if they're running at utilization rates, much lower. And I think it leads to Brent, and if you have crude sitting off the U.S. shore, are we going to see a similar pressure in Brent pricing going forward?
Yeah, definitely. I think this the water that will be poured into this fire will be just the mid distillate demand in Asia and most likely Europe, because we started hearing the news of some loosening quarantine conditions, lockdown conditions, and some normalization in life, like in Eastern Europe to Germany and also in Asia. So most probably the US refiners will be much more reluctant to produce in the mid distillate range. So that comes to your point. So they will be much more willing to buy this imported crude oil coming from Middle East, like let's say Saudi Arabia, Iraq, rather than the domestic crude that has relatively much less mid distillate yield.
Now, you brought up a good point when we were talking off screen in terms of, Angola and how Angola is really fed into the Chinese futures market. So we've seen Angola flow kind of shake off what we've seen where China's canceled Saudi crude. We've seen Nigeria just sitting there with over 2 million barrels of export with very little sold for May and June, but yet Angola is able to sell, I think they're only 7% below what they normally sell in the month of May. I mean, can you kind of go into some of the dynamics that you're seeing in the Chinese futures market?
Yeah, I think like what we see is like in China, especially crude imports increased for like, let's say most probably in April, and it was a high in March compared to February, June, January. And Angola has a different strategy than Nigeria. Nigeria is more like targeting in US market and European market, but Angola has really strong flow into Chinese market. And Angolan crude oil is a part of the crude basket for the Chinese oil futures, and also they have a really good portion in total SPRs in China. So they have the this advantage of moving their crude ability to move their crude oil into Chinese market, Asian market. So I think that's why they still can flow it by using the chance that their crude can be traded by Chinese oil futures. That's incredibly advantageous for the Chinese buyers. Even in this price range, I think they can still enjoy, and they can also minimize the currency risk in buying crude oil. That's, I think, is much more favorable. That's what the Nigerians cannot enjoy at the moment.
And it's interesting because you've seen the Chinese refiners come back pretty aggressively, even though local demand hasn't really picked up. So when you're looking at some of this flow, I mean, are you seeing a lot of it come into the European markets, or do you think it's going to kind of sit in some sort of storage as we see Singapore setting all-time highs for what's sitting in floating storage?
Floating storage. I don't think that there's so much space for floating storage anymore. So we hear that the total floating storage already reached to 120 million barrels, but I think effectively that's the Chinese refiners buying activity due to low prices, and especially teapot refineries can enjoy this because they don't have so much option about like buying power. And we also hear that like Russian flows from Cosmino and also the Aspa pipeline is also increasing. So this demand is there. Obviously, demand is there, and I think it's also the Chinese latest strategy to increase product inventories is now like in action. That's what we see, and like Europe, we also see the improvement in there because there is also expectation this lockdown will be over soon. And it's also a good opportunity because still there is storage area in ARA and Mediterranean, and for all these buyers, so it's not a why not situation. It's a why not period.
Yeah, it's interesting. When you look at China and you look at how they've tried to play the game, but at the same time, crude quality matters for them as well. So when you're looking at the optionality of saying, well, I can take lighter sour crude from a Saudi cut, or I can go to Angola and get a medium sweet and make a wide breadth of product at a lower cost for the most part, just in terms of how quickly they can have that turnaround. And you've seen a significant amount of diesel and distillate coming out of Asia and being pushed into either Singapore storage or moving over into Europe. And it's interesting because when you look at the crack spreads, right? So, crack spreads are going to be how does the refiner make money? And we've seen the gasoline cracks really come under pressure, but you've also seen the benefit of some of that diesel crack spreads really kind of holding up and being helpful. So now that you see this diesel coming through and starting to hit the European market, some of those crack spreads have come under pressure. I mean, how do you see the crack spreads going forward? Is there going to be a point in time where it doesn't even make sense for Asia to send over some of this product and it starts to get stuffed, as you pointed out, into some of the Chinese storage for refined products?
I think in terms of storage levels, it is not that possible to have the arbitrage to have like Asian product to flow into Europe, but like when looking at from the European refineries point of view, so that diesel gas oil margins could recover much quicker than expected. I think still the big unclarities about the jet fuel margins. It still seems that like realistically we shouldn't expect any recovery in terms of demand until maybe August, September. But Europe, especially like the truck movement, the land movement from Rotterdam into continental Europe, or the like trade from Russia to Germany might recover soon, because we also started hearing that the borders are opening. So the life is turning to normal, especially in Germany and Poland. So this might also help recover in the gas oil demand. So these margins could be healthy for mid distillates, but still from the light end point of the margins, refineries might not enjoy like good levels of margin. So it also comes to one point in the US, so US should also have the same problem with like the margin levels and the storage level, right?
Yeah, I mean, and it comes down to a huge problem in terms of storage on a refined product, as well as a crude problem. And the issue is, the markets have seized up, and the export market that we used to have, has gone away for, just due to demand from coronavirus and just lack of flow across the supply chains in terms of shipping and and you've had this logistical bottleneck. But at the same time, you also have, this competitive product coming in, and it's really hard at this point to really push that through. So, when you kind of take a step back and you think about, all right, well, what comes next? I mean, what are you thinking when it comes to, WTI futures and Brent futures as we look out over the next, let's call it 3 to 6 months?
I think in like when you look at from the Brent futures side, we seem that that's much more lucky, because as we discussed previously, there is still a way for Middle Eastern crude or like West African crude can flow into United States because of the crude quality and because of the product demand. And of course there will be pressure on the price side, because although when we are like, even if we are talking that these two markets are totally disconnected, they're not disconnected. There's still this connection between either side of Atlantic. It's putting pressure on the Brent side because of what's going on WTI side. But most probably Brent will not just have like these minus values if things will not go worse. Of course, there's always a possibility that things might go worse in what's going on with the coronavirus thing. But with all the news we are hearing about the recoveries, it's fine. But WTI, I think it's another story, because even if there will be a recovery in demand with all this oil coming and all the storage level, I think I would love to also ask you a question about this at this moment, because you're also following with the primary revision about the frac counts. And so how do you see all this happening, like affecting the drilling activity, completion activity, frac counts? So like, can you give us some insight about this? I think it's important.
Yeah, I think the biggest issue right now is going to be, how do we get those shut-ins coming? And when you're shutting in old wells, there's no real reason to produce new wells. So when we're looking at the frac spread count coming in from, over 200 to just under 150, we're looking at this and saying, look, this is going to go well below 100, probably start to normalize around 40 to 50, but you're also going to see these rolling shut-ins that are going to have to come to pass. And it's just because, like, as we talked about earlier, with Cushing oversupplied, you're running out of storage because there has to be a certain amount of movement within these tanks. You really can't hit tank tops in theory. You're going to need to see these shut-ins. And our focus is that they're going to happen very aggressively across Texas and Oklahoma. And again, it comes back down to that crude quality. You want to find the areas where you're producing a lot of NGLs, a lot of condensate, and very light crude, where you just don't have a market. So we think those are going to see the first shut-ins, and technically on a geological level, those are some of the easier ones to shut in. And then you're going to start to get more complex with, well, what is the longevity of this slowdown? in demand, and just given the size of the oversupply, the view is that this is going to reverberate well through driving season. You're going to have a very weak driving season, which is going to mean that demand is going to remain very low. And then you come back into shoulder season, which is that, let's call it end of August, typically Labor Day into, let's say, in middle of October, you're going to have that demand fall. Now, the other problem is, the OPEC plus meeting and what's going to happen going forward. And, we were talking earlier, which I'd love to get your view on in terms of exports, because, we keep hearing about production coming down, but yet exports remain, flat to slightly down, where you're thinking, well, why are exports still flowing if there's no real demand? And it comes down to official selling price versus local demand going down. So, we have this oversupply across the world, which is just putting more on the water, even though there's really no place to go. And now you have this competition, increasing on the official selling price, which is really away from the screens. So we talk about Brent, we talk about WTI futures, but there's an inherent weight, like this anchor sitting on it, just pulling it down, which is this physical spot market, which remains grossly oversupplied because the physical market prices out, starts to sell 6 weeks in advance. And we're just seeing May and June, just a massive glut. I mean, what's your take in terms of how that could impact the curve as we look forward, even though we might have some opening of economies?
I think, like, first of all, OPEC plus decision and their, like, whatever they're claiming as a decline or like a production cut is like far from being realistic. So what they're putting as a base production from October 2018, like for Russia and Saudi Arabia, it is like 11 million barrels per day fixed, but the cut will happen in May 2020. So actually it's very important what the production level in April 2020 be, and then what the production will go down in May 2020. And when you just look at these numbers, it looks like in effective, the production cut's much lower. So for example, just if you take 2019 averages for all the countries in OPEC plus, the effective cut in May would only be 20%. And as you said, like what market is expecting is lower exports, not lower production, because everyone is caring about the commercialized crude oil flowing into market. So when you look at this point, it is quite impossible. We see all the decline in production will be effective, will be visible in exports. Like even if this will happen, the maximum decline in exports would be 27% for all these countries. So it's actually not solving the problem for what we were just, the market was asking from OPEC plus. But the funnier thing is, like, after having this decision of a production cut, making another discount in OSP, like as a heavy discount for the benchmark crude oil for all the OPEC producers, for Asia and Europe, is deepening the problem. So that is the main problem, I think. I don't know what you think. I really wonder just how you think everything looks, but that is the main problem, because this is also killing the impact of your movement if you're still going in market share war, like a price war, let's say in market terms, having a deep discount after a production cut decision.
Yeah, I mean, it's interesting because you look at this and you have to say, well, you can say a lot of things, but you need to see supply demand really work out. And I think there's nothing that's going to be better to normalize in the market than, the demand forcing the supply out of the market. And I think that you're going to have to see some more pain, specifically in terms of negative pricing, specifically in June, possibly again in July, if we haven't learned our lesson and we don't see more shut-ins. And then I think you could see Brent come down into that single digit market, because I think now we're up to 15 locations that are selling physical crude for sub $10, in that global market. So I guess, to kind of close out, feet to the fire, do you see some negative pricing across the Brent and WTI structure going forward?
I think whatever problem we are facing with WTI most probably will be there when June contracts will be expiring next month, and probably for July contracts 2 months later. That is very likely that we will see similar scenarios, maybe not minus 40, but like in the minus territory, most probably.
I mean, minus
was,
40 is something special. I mean, I don't know if we could see that again.
Like, I really would like to just like have a T-shirt or something written minus 40 on it. It's a historical moment. Like, I think no one would ever could imagine this could happen. It happened. But I expect minus territory when it comes close to contract expiry dates for June and July contracts. This is what I am expecting. I don't know what I really hope things will recover soon. From Brent side, I think Brent, okay, because the effectiveness of Brent in terms of supply would be maybe much more wider compared to WTI, because it's nearly the rest of the world except WTI side, like Latin America, US, North America. And there might be some producers that will be forced to just cut production, maybe not because of operational costs, but because of the losses in revenues. Let's say Iraq, let's say Algeria, or like there are also some North Sea production could be impacted if this will go for like few months, and if this unclarity will not fade out quickly. But I don't expect minus territory for Brent. It is likely that we will see a short time, maybe below 2 digits for a very short while, but I expect it to recover a bit quicker. So from my point of view, I really wonder what you think. Do you really expect minus territory for Brent?
I think you could get a lot of pressure in terms of getting Brent down into that single digit. And that's really going to push WTI lower. Because if you think about WTI on a geographical level and a quality level, WTI and how it's really shown in the markets in terms of Louisiana Light Sweet or LLS and Magellan East, which is how we get into the market, you're going to have us trying to compete on a geographical location because the U.S. is really one of the furthest barrels. And then we also have some of the lowest quality in terms of the way a lot of these refineries are structured. So if we have a perpetual, low single digit into negative area, that's going to pull that Brent spread down. Because I think we're going to maintain about a $10 to $12 spread. It could obviously go wider. I think we peaked at about $45 spread yesterday with that collapse, which I don't know if is sustainable. But I think that it'll act as a weight, pulling that Brent price down, especially as you have other crudes that are being competitive in the market. Because crude quality matters.
Your idea about the Gulf of Mexico production, because we also see Mars is now like minus 30.
Yep.
Like it also saw that like minus 30 craziness. So because if you come back to the beginning of this conversation, so we were talking about the quality crude oil, like from domestic production, Gulf of Mexico is the quality crude oil, right? So how do you think this would affect total, like overall margin levels for the Gulf of Mexico refineries?
I think you're going to have to maintain some of that Gulf of Mexico production because it's key for blending. A lot of the Eagle Ford crude or condensate, depending on how you consider it, it gets blended into that Gulf of Mexico. And Gulf of Mexico crude is typically production of about 1.97 million, to about 2 million a day. And it's really the quality stuff that helps these guys operate. So it's something that I think is relatively sticky, but at the same time, over 90% of it is on federal land. So if the U.S. really wanted to do something unique in terms of forcing people to shut, does it make sense to have the Railroad Commission roll out cuts throughout Texas, or does the federal government mandate that something has to be cut by a certain percent within the Gulf of Mexico? Now, I can assure you anything like that would immediately go into legal. And you would have that get fought in courts instantly because there's a lot of guys that make a lot of money just due to the fact that the Gulf of Mexico has some of the lowest cost. When you factor in tiebacks and sunk cost, wellhead economics make a lot of sense, specifically on decline curves versus U.S. onshore. So I think U.S. onshore would be the best way to rationalize, just because some of those negatives in terms of spreads can normalize and will only be short-lived, where I think some of the issues onshore are going to be longer term and is the better place to kind of fix the problem.
Yeah, like Mark, like we both are being oil nerds that I think we can talk about this like until morning, but just to quickly ramp up for everyone. So like I would like to ask you as a final question from my side. So what should we expect tomorrow? Because it will be the start of June. June will be the front month. But then we also know that US oil fund will jump back to again the second month. So what should we expect tomorrow onwards, maybe until 21st of May?
Sure. I think you're going to get more pressure in the June contract. If you look at just how people have come into USO, and just the little clarification of how USO trades, the USO roll already happened. So anyone who thought they were getting May at a discount were actually buying June at $24, $22. So I think that there are going to be those fly-by-night tourists that thought they could get some oil nice and cheap without really appreciating the dynamics behind it. So I think you're going to get people selling because they're like, you know what, I don't get EMP, I really don't get oil, I'm out. And I think the better way to play a recovery in oil pricing is really picking, let's call it your 3 to 5 top E&P names instead of trying to play the oil market. Because as we're talking, like there's macroeconomic, there's geopolitical, there's supply demand all at work that make it so hard to really kind of nail down when this price is gonna get back in your favor. So I think that you're going to get pressure across the June, July contracts. And I really think that this is going to last well into the summer, specifically as, I don't see gasoline demand recovering anytime soon. And I think refiners are going to be trapped with a lot of product.
Yeah, so I think we should expect the minus prices to be our reality maybe for under 2 months and then hope for the best for the rest.
No, I absolutely. So, just to wrap up, feet to the fire, what are you thinking in terms of Brent? When are you going long or are you shorting more?
Very hard question. I would go short a bit because I really expect recovery in Europe soon because I'm physically in Europe. I just physically see by myself the recovery in here. We see the loosening of lockdowns and just things are going forward and shops are opening. People start to going work. People start driving. In terms of Europe and Asia side, I am much more optimistic in demand and like in Brent side than WTI. WTI is, I think, a nightmare.
Yeah, I agree. So, well, I appreciate the time. We'll be coming back to you again. Please subscribe if you haven't. The little button is on is right there, and we'd love to hear questions from you that we can answer in later sessions. So again, I'm Mark Rossano from C6 Capital Holdings, and this is great to introduce Serkan Sahin, who is Hormuz Straits Partnership. So thanks again.
Thank you so much. Thank you. We'll be watching your Frac Spread Count video on Friday.